Hi, everybody. It's nice to meet you all. Thank you very much for joining. Well, I guess we got caught up, Charles and Alex and I got caught up in the conversation. There's so much stuff to talk about. So I'm very, very fortunate to get to spend the next 30 minutes with these wonderful, smart gentlemen. And I hope you're going to enjoy the conversation as well, too. So I think what we'll do is we'll do quick introductions. I'll introduce myself first, and then I'll turn it over to you, Alex and Charles. So my name is Marvin. I have the joy and pleasure of actually moderating this session. This session is crisis vintage for VC, right? And what I'm going to talk about, so I'll introduce us first and we'll go into sort of the topic afterwards. My name is Marvin, moderating this panel. I was previously a fintech investor, so I've been in Silicon Valley now 21 years, San Francisco. Did startups for several years, was an executive at Yahoo for about a decade. Most recently was a partner at 500 startups, so I invested in over 400 seed stage and pre-seed stage companies, and I did probably about 35 fintech investments. Ones you might know of in Broker, Indio, which just recently exited as well too, and have recently left and now just angel investing and boards and just goofing around and joining wonderful events like this. Charles, Alex, why don't you introduce yourself and then I'll turn over to Charles afterwards.
Sure, happy to. Yeah, thank you for inviting me. Really excited about joining an online event. We're having our own hop-in event with LPs, so we'll see how that goes. So yeah, there are about 40 CIOs who've already joined. So yeah, we're going to, this is a great opportunity. One of this. So I have some scars. I have actually been through two of these. So I was in optical networking, actually started an optical networking company in year 2000. And then I've been through 2008. I do LP investing and company investing and company and tech company building. So lucky to be involved in some of the premier funds that are big names today. Mm-hmm. And then also as excited about this, lucky to be involved in some really amazing next generation funds that will be big names tomorrow. Yep. So do fund investing and company investing, and also company building through studios and incubation.
Great, awesome. And Alex is going to provide sort of not just a sort of like the direct sort of like perspective, but also from an LP perspective as well too, which is why he's on here. Charles, from the investor side, please introduce yourself.
So, thanks for having me. Charles Birnbaum, I'm a partner in our New York office at Bessemer Venture Partners. I focus almost exclusively on fintech and financial services and kind of lead that practice for us. I've been with Bessemer for 7 years now. Prior to that, I spent the first 6 years of my career on Wall Street in technology, investment banking, and then capital markets, and that's where I spent the last crisis. And then coming out of business school, I was one of the first employees at Foursquare, and had some operating experience for a few years before coming to the dark side of venture. Here, I'm on the fly, living through this epidemic on about 11 boards. I serve as director on 7, and observer on several others, some at very early stages, maybe even pre-product, pre-revenue, some that were contemplating exits or even potential growth rounds in the near term. So getting a pretty wide range of experiences living through this unusual time.
Yeah. So to set this up, right, this is the vintage crisis of VC. I want this to sort of be practical and useful for everybody. So, I guess what I would say is 2008, 2009, 2010 were like amazing vintages for VC, right? And there were some specific dynamics that came of it. And I assume that you anticipate that's going to be the same for 2020, 2021, 2022. Just curious thoughts.
So let me go first, and I'll tell you why. Even though you're right, 2000, not so much 2008, but 2009, 10. Once the dust settled. So you're talking, the dust hasn't settled. There are unknowns. Once the dust settled, it's the best time to invest. Yeah. 2009, 10, 11, 12, fantastic vintages, right? Yeah. But guess what? They're also the hardest in vintages to invest in. And why is that? It is because up and down, people think LPs, everybody will say, well, we just raised what Lightspeed raised 4.5 billion. Bessemer raised what, 2-3 billion, Lightspeed raised, and recent raised. So, we have all this capital. But guess what's happening? Their capital is from institutional investors. Those institutional investors' portfolios and operating business, not just the portfolios, the operating businesses are hurting. Harvard, and this is public news, Harvard is cutting down salaries, right? Harvard is freezing. So what happens is that all of a sudden, when they are not getting any more donations, and the operating cost has to be more. So even though the VCs have money, they're like, yeah, we're in business. Their LPs tell them, well, guess what? You are in business, you've raised these big funds, but we don't want you to call capital. And actually, it's not happening now. I just want to be clear. But this is what happened in 2008, 9, and 10. So most of the LPs said to their GPs, look, we want you guys, I know it's a great time to invest, but we don't want you to think. And by the way, that's why some of the newer funds, and I'm not against the established ones, this is some of the newer funds did the best. Why? Because they didn't have a big legacy portfolio.
Right.
A lot of these, great names now have all these big unicorns, the 400 unicorns. If you have 20 unicorns and 9 of them are hurting, you're wondering how to prop up the portfolio. So great time to invest. But also,
but very difficult time to invest is what you say.
So, I mean, look, I've been leaning on a lot of my partners who've been doing this a lot longer than I have, and talking to them very frequently, and folks that have a lot of great experience, like Alex. As I'm in a position where I could be making new investments, but I'm also trying to manage helping my entrepreneurs through this period of unknown scenario planning and kind of tracking second degree metrics week over week, day over day, to try and read through the tea leaves on what decisions we should be making. So I think balancing those two things, I think everything you guys said is right. The hard part is waiting until that moment when both the market resets and comes to grips with a little bit of a new reality. First of all, people focus a lot on the equity market and the fluctuations, but we're always thinking about things on a 7 to 12 year time horizon, really. And one of the challenges right now is making an investment that you're going to be living with that long. But at the same time, that doesn't really change for an early stage investment, whether it's a seed or a Series A or Series B. The semantics of those things have gotten a little bit out of whack in the last 7 years, but that I've been doing this. But I think when I think about an early stage investment, I do think valuations will adjust. I don't think they will adjust until well after kind of the COVID dust settles. There's a lot of capital floating around out there, a lot of well-capitalized companies that have other alternatives to buy time. And I think we're trying to think about all as individual investors at Bessemer. I can speak. We all have roadmaps. I have several areas within fintech that I've been excited about for a while. I think some of those will have kind of COVID tailwinds, some will have COVID headwinds. How does that change my perspective over like the next 5 to 10 year time horizon? And we can talk about some of those things later. But it is obviously historically been a really good time to build category defining companies out of those moments of crises. But as Alex said, when you're in the position to pull the trigger, whether you're waiting long enough for kind of the dust to settle.
So tactically, for both of you, what are you telling your portfolio companies, right? Like, and we talked about this earlier, where there's a subset of portfolio companies that are like well positioned, right? Sitting a lot of capital, positioned very well, servicing specific sectors are going to grow in the fintech space, and other ones were like, holy crap, you're doing loans for SMB retail, right? And that's gone. So what do you do in those situations, right? Like, what is advice you're giving your portfolio, like tactically?
Yeah, it's all over the place. So maybe I'll speak to this one just because I'm living it day in and day out, as I mentioned, across about 10 or 11 companies that I'm talking to every day. I think now's a great time to be a seed stage company that might be well financed for a year plus and just in building mode, getting to observe all of this while keeping your team focused on building product. If you're in a business that had the rug pulled out from under you, let's say you're in the restaurant space or
travel,
things that are touching travel or construction or entertainment and physical entertainment. You have to make hard decisions right away. I think the harder one, so those are the two extremes. Most stuff is in the middle, where people didn't necessarily see an impact in Q1 because there was only, let's call it 10 to 20 days of true disruption in Q1 to most people's business. And Q2 we're going to see all the data. We're trying to track it, as I mentioned, kind of day over day, week over week, instead of waiting for that quarterly data to come in. And then the really hard part as a board is coming together and making, putting a stake in the ground on, you don't want to predict what's going to happen. Is everyone going to be back to work in July, in September of 2021? You could make a pretty logical case for any of those things with the data at hand right now. And it's kind of trying to find the balance and do all of the scenario planning just to frame the decisions at hand. And a lot of people are artificially saying, let's just get to more than 18 months of runway in a specific scenario. Some are just taking a wait and see approach because they haven't seen the impact on their business yet. But I think across the board, I'd say hiring freezes are almost everywhere. Except for maybe critical roles, even for companies that are still growing nicely. And then we have seen many companies start to consider material cuts where they've seen impact in their business. But it's there, you can't paint this with a broad brush. And I think this is a different crisis than most because it's impacting everything and it continues to roll. The data is going to continue to roll in for several months.
Alex, love your perspective, right? Why is this a different crisis?
So I think the big thing is, most of the first of all, if you need to raise new money, now, you're screwed.
Yeah, don't do it.
Nobody is writing new checks. Yeah. Right.
And why is that? Why is nobody writing new checks? Right. Just so people know, so they understand.
It's just culturally. One is there are unknown unknowns. Also, most of these established firms, they have a process. They meet with the thing. They will have dinner. I bet you 90% of the traditional funds have not done a Series A or B where they take a board seat without going to dinner with the founder a couple of times, right?
You're getting married. You're getting married.
They're not going to write. They're not. So the people who are most transparent, most authentic, they are telling people, look, we're not going to do these, right?
And there's no divorces.
Huh?
And there's no divorces.
Yeah, there's no divorce in VC.
Yeah, there's no divorce. Yeah, of course. Yeah, there's no divorce. Yeah. It's just.
I'll speak. I think perhaps there's a world where there's some investors that have been around quite some time and have the fortitude to do that. I've only been in a VC for 7 years, and I certainly, there's relative investment size to the size of our fund. We invest out of a $1.85 billion vehicle, so to start with a small check relative to the size of our fund during these circumstances, perhaps I can contemplate some of those, but to really lean in and become the lead director and ride shotgun with an entrepreneur for the next 10 years and not have spent physical time with all of the executive team one-on-one in a room and really get to know the culture of the company, really difficult. Just to pull the trigger on that, even if all the stars aligned on it being a great company. I'm still meeting many companies virtually every week, many of which I've met in the past in person. So, perhaps one of those comes together, but to start a net new relationship over Zoom and execute one of those is very hard to imagine.
So I'll tell you who is going to win in this scenario, right? So there are some funds, and we're investors in one. There are some virtual funds. Not a lot, but just like there is Hopin, we're on Hopin and Around and Tandem and all. So there are actually people who had configured virtual funds. They were doing their company investments over video calls, right? Now all of a sudden they are architected so that they are getting their diligence data from other sources, not from the physical interaction. So they are at an advantage. And that same dislocation, displacement you saw, which in the last today YC is one of the strongest investment platforms on the planet. I don't know whether it's top 5, top 10, top 3, but in 2008, it wasn't, right? That displacement caused YC to emerge. This displacement is going to allow a next generation fund, which is architected for this, to emerge.
Right, right. Yeah, sorry, Charles, you wanted to add something? Hey, Charles, I think you are
on to the question Keith Smith asked in the chat, because I just wanted to clarify. I mean, I'm speaking personally. I think there will be investors that are comfortable doing so, and I think kind of the relative investment size to the size of a fund is a critical thing to keep in mind. And also, as Alex mentioned, some funds are set up differently. You know, I'm personally talking about I might make one or two investments, like really true lead investments, where we're taking meaningful ownership and plan to reserve a lot of capital for them and invest over the course of 7, 10, 12 years, you know, which is what some of our big winners typically take. So, you know, thinking about making one of those in a rushed fashion over the next couple months without having a chance to shake someone's hand to answer your question, I think that's really hard to contemplate. I'm just talking personally. Maybe if I had been around longer or had a little bit of a different fund structure, you know, I think there will be deals that still get done. I just think you're going to see a real sharp decline over the next few months.
Yeah, I think also to answer Kevin's question, I think a lot of it is really dependent on the size of the checks, right? So I have a friend of mine. He does a bunch of angel list syndicates, and his check is maybe like 150 to like 350K normally, and he's never met any of the founders. He's always all calls, right? He's probably one of the most active, like sort of like early pre-seed seed investors. That's very different. I think if you look at a lot of the VC funds, they're just not structured for it, right? Like structured for sort of not just like meeting the founder, because you're doing $10, $20 million checks. You want to get to know the founder, I think, versus sort of like in these situations in earlier stage. I think they're very.
It goes beyond the founder. It's like it's really meeting the whole team and getting a feel for the business over several visits, over different, you know, I even struggle sometimes with very fast, rushed fundraising processes. You know, like most deals I've done personally in my time as a partner at Bessemer, I've actually gotten to know the team over a few years before investing anyway. So it doesn't change much. I'm just trying to shed some light on I think how it will impact quarter over quarter or month over month you know, volumes you see in Dan Primac's term sheet, you know.
Right. And so let's talk about the future now, right? This is a fintech related, you know, sort of like event. What are the areas specifically in fintech that you're interested in, sectors, right? Fintech is a very, very broad area. What's exciting? You know, what's exciting for you guys? What are you seeing?
Yeah, you know, so I'll tell you kind of things that we are really interested in. Of course, we have fintech exposure. So we always, my background, spent 10 years at Bell Labs and trained as a computer scientist. So I love developer-facing tools. So I think this is even this side will even make it better for, you know, we'll see the next generation Braintrees and Stripes and Adyen's created in this. And I think Plaid was just the beginning. There's going to be a sea change of developer-facing tools coming globally. So that's the other thing, you know. So I think that developer-facing tools really thing. And I also think this question, you know, I think that a lot of we go through this hype cycle, like we went through the hype cycle in lending, we went through the hype. Now we're going through the hype cycle in insurance. Yeah. You know, we'll see whether it plays out. So I think we'll, you know, and also banking. So I think, you know, there are a lot of these hype cycles, and you know, not that there wouldn't be great companies built into those, but we try to. I think this COVID crisis is going to deflate some of those hype cycles. It already has, but you know, I think the underlying infrastructure, unlike the last thing, right? If you look at it, it's not the infrastructure companies in the old economy that are the biggest, but I think in the new economy, the infrastructure companies will be ascendant.
Yeah,
okay.
I agree with all that, and that's actually how I've been focused on those areas for quite some time. We have a very long history of developer platform businesses as a firm, even outside of fintech, with as the lead investor at Twilio and Auth0 and SendGrid and some of these great companies. I most recently invested in Alloy in the fintech space, which is a developer platform for identity. for account opening and credit decisioning and fraud detection. So I think that you'll see more focus on the infrastructure plays. That was already starting pre-crisis. I think there's two areas I've been thinking a lot about over the last few weeks that are fundamentally kind of arbitrage opportunities that have existed within financial services for a long time that I think might get kind of the kick in the pants that make them more mainstream. And one is, employees really funding their employer by waiting in the 2-week pay cycle. I think that's obviously becoming an emergency that the government's having to step in on, and you've seen a lot of kind of short-term solutions where direct-to-consumer new forms of payday lending have emerged to underwrite based on new forms of data that Plaid has enabled with the bank account, the Daves and Bridgets and Earnins of the world. But I think working with the employer to solve that problem is going to be a really interesting new area of focus. There's a lot of companies that do this, even, and there's some earlier stage business as well. I think that's one that'll change fundamentally. And then the other is smaller suppliers financing their buyers. And there's been a lot of companies like the C2FOs of the world and Talios and TradeShift. I have a early stage company in the UK called Provise that's working on this problem. I think that's another one that'll change dramatically coming out of the crisis, because it is a crisis, and I think they'll see uptake, even though in some ways you're going after an embattled customer. I think those are ones where perhaps the regulations change to allow it to be easier to solve those two fundamental inefficiencies in financial markets.
Yeah, we're also give a plug to Drip Capital. We're also investors in Drip. They do the same, and they do it globally. So they're definitely a great market.
Yeah. And just to come back to the point on like direct to consumer, I mean, InsurTech, you mentioned the Wave, and we as a firm, my mentor Rob Stavis invested in the earliest rounds at Betterment coming out of the last financial crisis, when there was, what we thought was kind of a once in a lifetime opportunity to build new, durable, enduring brands for financial advice for a consumer that was just becoming mass affluent and was not served by the current market. I think there will be some of those opportunities that come out of this as well. Unfortunately, probably more down market and for the underbanked segment. So again, I think these were opportunities that existed before but might accelerate.
Yes.
And I'm also kind of kind of the biggest question for us is what's going to be kind of the black swan innovation in this I think last downturn it was Bitcoin and crypto. I think it's like what's going to be the kind of the black swan innovation of this this downturn. So.
And I guess we're because of the uncertainty, we're still trying to figure that out right now, right? We're only like 6 weeks in, right? Like which is crazy. It feels like 10 years, but it feels like
and actually it's a V-shaped recovery in the stock market, but the stock market is not the economy. So.
I think obviously a lot of the companies that will be most badly impacted in the first wave will be ones that have balance sheet exposure, just because as your liquidity alternatives decline, it's more challenging for equity investors to stomach that. It's almost like, in some ways, like a hardware business where the better things go, you consume capital, but then when these dislocations happen, you also consume capital. So there's a lot of good new forms of lending that have sprouted up, but those companies are going to have to weather this storm more quickly than others. Yeah,
for sure. We have probably about 5 minutes left, and as I said, I want this to be sort of like actionable. What is one piece of advice or one thing that you think a founder should know coming out of this? Just like what was one piece of advice, actionable advice, that you would give any founders right now to survive this? Because we all know there's going to be amazing companies that are going to be built in the next 2 to 3 years, right? Like crazy good companies. What is a piece of advice that you give them to sort of help them weather the storm, or how to think about it?
So I think we invest in both companies and funds, and we think. So I think there is this fetish with logos, right? There is this fetish with logos, whether it's a company, it's a fund, and all these big funds, present company excluded, they want to give a lot of money to founders, right? They want to give a lot of money to founders because they want because their fund sizes are big, right? And they want to move the needle on their fund sizes, and that comes to roost in times like this. Why? Because you have incredible burn. You can't sustain that burn. And you know, so I think this is like, and we were seeing, you know, in the last crisis, Eric Ries and Steve Blank, they worked on this, like the lean startup, right? All of a sudden, the lean startup was a bad word. No, raise as much money, be full stack, burn as much money as you can. Why? Because XYZ is going to give you an up round. Right, so I think it's finally come to roost. It's just like Assurance IQ. Well, how much money did Assurance IQ raise? It's in a fintech space, right? Zero. It raised nothing from VCs. In 3 years, there was a $3 billion outcome. So going back to it's going back to unit economics, going back to profitable growth, and going back to solving things that customers really want. I am flabbergasted how many companies I see across portfolios that are written up. They've gotten things. They don't have a product market fit. They don't have a product market fit, right? And they're scaling. Why? Because some VC really loves them, and some other VC is writing them $100 million check. So I think this is kind of a wake up call for founders.
Yeah.
Build things that people want.
Yeah.
You know, real customers matter. Unit economics matter. It doesn't matter if you grew 6x year on year, burning $200 million, because, you know, SoftBank is going to it. SoftBank just wrote $24 billion down in their portfolio,
yep.
Right? So I think that is the big message. It's not the logos, you know, it's building a profitable business.
Yeah. So you're basically, Alex, you're basically going back to basics, capital efficiency, having business models that make sense, having margin that actually makes sense, right? Having having margin, period.
And who cares who invest in your company? I don't look at it as XYZ has, you know, invested on SoftBank. People were so scared. Oh, SoftBank is investing in it, so they've anointed the winner. Well, is OYO a winner? Right? Is WeWork a winner? Right? And you can go down the list. It's almost the anti-opposite, you know. Yeah, antithesis winner.
The cash cannon strategy is clearly not working. Charles, your closing thought.
Yeah, no, I mean, just something a little bit more tactical. I agree with all that. I kind of agreed with all that a year ago, 2 years ago, 3 years ago. You know, we've just been trying to navigate this period of exuberance where we're competing with people that focus on those things, Alex, frankly. You know, I feel like we invest out of a large fund, but I'm one of 15 partners, and we want to invest as little as possible for as much ownership as possible, not necessarily force companies to take money. So I do agree with everything you said. I think the tactical thing for those founders on the call that are thinking about raising money over the next 9 to 12 months, I think start building those relationships now, virtually. Don't hesitate to do so. We're all open for business and working a little bit harder than normal on our existing portfolios. But I think just reasonably call the question to an investor like myself on that call. Say, you know, do you think you could close and fund a deal while we're in this period, and of what size? You know, like kind of what is your appetite, and how many of those? I mean, just ask honest questions of the investors you're engaging with, but I wouldn't wait until after the dust settles to start maintaining those relationships, building those relationships. But you can get everything far along, and then hopefully when we're all getting together in person again, maybe not shaking hands ever again, we will be able to execute some of those things more quickly. So I would kind of keep at it and keep reaching out. You know, still doing as many calls as I typically do, just trying to be really transparent with people on timelines. And timelines, I think, are going back to what they used to be, which was getting to know people over several months before making an investment decision.
Yeah, we're going back to rationality, basically, right? Like going back to basics and back to rationality. I would say my sort of feedback and thoughts and what I've been telling my portfolio companies is just like, look, you got to manage your cost structure very, very carefully in the next 9 to 12 months, where there's just not a lot of certainty. Very, 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 very important, right? Like zero-based budgeting is going to come back with like if you aren't doing that right now, you are toast, right? Like you need to be bringing that back at all stages, right? And so somebody asked you questions. Just one last question before I let you go. How does this advice change for pre-seed and seed versus growth stage A and later? Charles, I want to let you cover that very quickly, and we'll close off.
Yeah, I think I've actually personally seen quite a few pre-seed and seed deals get done over the last 4 or 5 weeks. Deals that I thought were quite interesting, and term sheets are still getting signed. I haven't seen the deals fund necessarily, but I think pre-seed and seed. I think that market, you're betting more on the people. So some people will take the view that just without getting to know them in person and spending time with the whole founding team will be hard. But I think in those rounds, if you can get something done, try and make the round as large as you can, and don't get too cute, as Alex said, on who's investing. Just get started building. What better time could there be to be building without the forcing function of quarter over quarter productivity showing to a board and to an investor. So I think it's a great time to be building pre-seed and seed stage companies. I think the growth stage A and later, you're just not going to see very many deals get done over the next several months, because there's going to be just a gap between investors who think the market should be somewhat repriced to account for the unknown unknowns, and founders who don't think it's going to be that bad. So I think you will still see pre-seed and seed deals get done. I think you'll see large funds drift down and do more of those deals in this environment. That's my prediction. So that's how I'd break those down.
Yeah. I just want to do a time check. I think we're a little bit over time. Is that right?
Yeah.
Okay.
Yeah.
So, just be respectful of everybody's time, and to make sure we keep this thing sort of like going. Number one, net, I think out of all this it is going to be a tough time. But if you can survive, there's going to be some amazing companies built during this time. And so I think the advice that my fellow sort of panelists would say is like, keep at it, right? Like keep on going, manage your cost structure, focus on the basics, and you're going to come out of this, like we're going to come out of this like in really, really great shape. And I think fintech is incredibly well positioned overall. Please, thank you, Alex. Thank you, Charles, for joining and for sharing your sort of your insights and your wisdom.
Thank you. Thank you, Marvin.
Thank you, guys. And good luck, everybody. And be safe.
Yeah, take care.
Stay safe. Yeah.